Hey everyone, welcome back to Corporate Decoder. Today we are diving headfirst into Hercules Capital's annual report, and get ready, because we're about to decode some serious financial fireworks, and let's just say not all of them are going exactly as planned, so strap in. Because we're about to unpack what these numbers really mean for Hercules Capital and their investors. And hey, before we dive in, if you appreciate getting straight insights from these corporate documents, make sure you hit that subscribe button. We also have a fantastic Discord community linked in the description below where we break down more of these filings. This is the big one, folks, the 10K filing for the year ending the 31st of December, 2025. Think of it as the company's yearly report card, and we're here to grade it. Now, the part that really tells the story, Hercules Capital is talking about its game plan. They're focused on high-growth tech and life sciences companies, mostly making senior secured loans and grabbing a piece of the equity pie through warrants and other cool deals. Their goal to boost income and the value of what they own. Since they started, they've committed over $25 billion to more than 700 companies. Pretty impressive. They even manage other funds, which adds another layer to their business. Let's talk numbers. As of the 31st of December 2025, their investment portfolio was worth a whopping $4.46 billion. That is a jump from $3.66 billion the year before. A big chunk of that, over $4.2 billion, is in debt investments, which is their bread and butter. They originated nearly $2.9 billion in net investment commitments in 2025. That is an increase from $2.1 billion the previous year, and they actually funded over $1.6 billion in debt during 2025. Now, it is important to know that even though they originated a lot, some of that was for other funds they manage. So the net number is what matters for Hercules itself. They still have about $385 million in unfunded commitments. That is money they've promised but haven't paid out yet. This is important because it is a future cash outflow they need to manage. Their total investment income was up to $532 million in 2025, from $493 million in 2024. That is good news, showing they're bringing in more money from their investments. But here is where it gets interesting. Their effective yield on debt investments, which includes those early payoffs and special fees, went down from 13.7% to 13.3%, and their core yield, which excludes those one-off items, also dipped slightly. This means the underlying business of lending is bringing in a little less despite the higher overall income. Where are they putting their money? Well, they're heavily concentrated. Over 24% in application software, another 23% in drug discovery and development, and almost 19% in healthcare services. This concentration is a double-edged sword. It means they probably have deep expertise in these areas, but it also means a major downturn in any one of these could hurt them badly. Now, for the realized gains and losses, in 2025, they actually had a net realized loss of $40.8 million. That is more than the $31.7 million loss they had in 2024. This means they're selling some investments for less than they paid for them. They chalked this up to a mix of sale of equity positions, bringing in some gains, but those were outweighed by significant write-offs on debt investments and some equity and warrant investments gone bad. It is like selling a stock for less than you bought it, and that is happening more than it did last year. On the flip side, their unrealized appreciation for 2025 was positive $38.8 million. That means some of their investments that they still hold have gone up in value on paper. This helped cushion the blow from the realized losses. Now, let's talk about the risks. They make it very clear that investing in their company is risky. They operate in a super competitive market, meaning lots of other firms are after the same deals, and that can force them to accept less favorable terms. They also say they rely heavily on their senior management team, especially their CEO Scott Bluestein. If he were to leave, that could be a big problem. That is a classic sign of a company with key person risk. And remember, they invest in private companies which are hard to sell quickly. This lack of liquidity means they might not be able to get their money out easily or at a good price, which could lead to losses. A big chunk of their portfolio is also in technology and life sciences. And if those industries take a hit, they could lose a lot. They're also a non-diversified company, meaning they can put a huge chunk of their money into just a few companies, amplifying their risk. And they are borrowing a lot of money. They have over $2.3 billion in debt outstanding. This leverage, while it can boost returns when things go well, also magnifies losses when they go badly. It is like a seesaw. If one side goes down, the other side goes down even faster. Let's look at the actual financial statements. As of the 31st of December 2025, their total investments were valued at a little over $4.4 billion. Their liabilities, mostly debt, were about $2.3 billion. That leaves them with net assets of about $2.2 billion. Their net asset value per S-share was $12.13 at the end of 2025, up from $11.66 the prior year. That is a decent increase, showing growth in the value of their underlying investments. But when you look at total return, which includes share price changes and distributions, it was about 3.2% in 2025. Now that is way down from a whopping 32.8% in 2024. So while the NAV per S-share went up, the overall return to stockholders was much lower last year. This is something to watch, so what is the story here? Hercules Capital is navigating a challenging market. They're making big bets on growth companies. And when things go right, they seem to do very well, as evidenced by that 2024 total return. But the increased realized losses in 2025 and the dip in core yield show that the lending environment is tough. Their heavy concentration in tech and life sciences is a significant risk, and their reliance on leverage magnifies both potential gains and losses. While they've recently issued more debt, ensuring they can manage it all and maintain their positive NAV growth will be key. What are your thoughts on Hercules Capital's strategy and their latest results? Let me know in the comments. If you found this breakdown helpful, hit that like button and subscribe for more. And don't forget to join our Discord community linked in the description where we continue these conversations. Thanks for watching.